Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucy, and some of you know me as Triangle Investor from social medias. Today, I have a very special guest. She's the founder of Prinsights Global. She's a geo-macroeconomist, the author of few bestsellers. If I'm correct, 6 or 7 books published so far. Dr. Nomi Prins, welcome to my show. It is really an honor to have you here.
Thank you so much. It's a pleasure to be on.
Thank you very much. I have been following your work for years now. Actually, I had the pleasure of listening to your speech on Rule Symposium in Boca a few weeks ago. By the way, it was a great speech. We have a lot of things to discuss here. I would like maybe if we can start with your background and if you could tell me more about Prinsights.
Sure. Well, my background, depending on how much in history I go back, I did work on Wall Street from when I was a teenager, basically. I worked through Wall Street in New York at Chase Manhattan Bank, Lehman Brothers. I started and grew an analytics department at Bear Stearns in London in the 90s, then came back in the early 2000s to Goldman Sachs as a managing director, ran a couple groups there, and eventually left that environment to really speak out, to pursue journalism and writing and talking around the world about what was going on inside the financial system, what still goes on, and how that impacts policy, the economy, real life, and such. And that's really expanded into multiple hats that I have working with various governments, particularly US government on policy that relates to the real economy as opposed to just financial speculative situations. And also I did develop just recently, I launched a company called Prinsights Global, Prinsights with Prinsights Global, through which I have different aspects. One is working with corporate and other types of entities on specific research projects, and the other is a Substack that's available to the public, which is Prinsights.Substack.com, where I follow commodities, real assets, the Fed, central banks, the dollar, infrastructure, energy policies, and all of the different kinds of combinations of those things that are really impacting our world today.
Okay, we will leave the link on Prinsights on the description of this video. I want to start with the broad question. How is your view on the economy macro outlook, and what is the current state of the current market? What are some key highlights here to mention?
Yeah, so in the United States, I'll start with that and sort of expand globally. Growth is anemic right now. We're looking at growth figures of last quarter's 2.9%. The first quarter was revised down from 1.6% to 1.3%. The second quarter was revised up a little bit from the 2.9%. But the point is that when you adjust it for just really standard inflation, which is now kind of down to the 3% area, give or take a couple of points of a percentage point on any given month, we really have flat economic growth in the United States. And that is not different from what it was before COVID. We did see a deep decline, of course, in growth, and then a big incline and steep percentage increase in growth after that decline. But on the average, and I wrote about this in my book, Permanent Distortion, my last book, the relationship of the economy of real growth to, for example, the markets is very, very different. There's a big gap. There's a distortion between the two. So we look at anemic economics, but we also look at around the world at economics that are effectively anemic, a little bit better in the major emerging countries like China, of course, much higher than the United States, India, some of the BRICS nations. We're looking at higher growth levels. Europe's pretty anemic as well when you adjust for inflation. And that's really the period that we're in. We're in a sort of slow to stagnant growth period, depending on which quarter you look at. And even if we look at 2 or 3% upwards, we're not talking about massive changes in growth. That's overall. There are sectors, of course, and there are transformative areas within the overall economy where we do see much more significant growth. And I do see much more significant growth potential if you break it down. For example, the energy sector, a lot of the commodity sectors, because we are transforming as a globe, as a world, into new forms of energy storage, new forms of data analysis, AI requirements, energy alternatives, as well as renewable energy components, as well as still dealing with old traditional energy. So there's a lot of technology and AI and energy transformation that's going on. Those are the areas that will continue to see growth. But overall, we're seeing a sort of slow to maybe down, maybe up, depending on the quarter type of growth.
Yeah, agreed. We will touch on the certain areas. Nomi, what are the real impact of the Fed's recent policy decisions on people's money? What would you say?
Yeah, so the Fed was late on the whole inflation issue that they called it transitory, and then they sort of jumped in with what has become from March 2022 through July 2023, basically a pretty steep increase in the level of interest rates to try and combat inflation. So in the United States, that went from in March 2022 at 0% up to where it is now, 5.25% to 5.5%, where it's basically stayed for about the last year. But during that period, what's happened and the ramifications to individuals, to finances, to what we're now seeing is increasing and record bankruptcy momentum coming back into play, is that the pace of that increase was so quick that it caught a lot of people and companies financing short. So for example, mortgage interest rates in the United States almost doubled, and people's payments almost doubled. And so what people were paying for mortgages, for credit cards and so forth, really increased dramatically along with that very quick increase in interest rates. And the overhang from that is something that we're still feeling. This is why we're starting to see personal bankruptcies increasing, small business bankruptcies increasing. We're seeing delinquencies and defaults coming into the mortgage market and so forth, because what it's created is a financing stretch for people on the ground. Now, the other impact that the Federal Reserve has had, that they say they have had, is to reduce inflation. I've never really believed that the Federal Reserve has anything to do with anything but monetary inflation. So asset prices that have to an extent come down after their post-COVID shock, or normalized after the invasion of Russia into Ukraine, which also had a major impact on commodities and global prices, especially in energy and agricultural commodities, has to an extent subdued and worked itself through the system. Levels are still high, but they're not increasing like they were. That has nothing to do with the Fed. So there are two things we have to keep in mind about the Fed. Its fight, supposedly its dual mandate, is to tame inflation, keep price stability, as well as full employment, or whatever it looks like, positive employment scenario to the United States. And what has happened instead is, though inflation has come down for these other reasons I just mentioned, the Fed really hasn't had a major impact on that, but it has hurt and will have overhang in terms of the cost of capital to the average person, the small businesses and so forth. And we're going to continue to see those numbers coming through. With regard to the labor market, we have seen our unemployment rate go up to 4.3% from 3.7% in the beginning of the year. It was just down at 4.2% the very last reading, but it's increased, and it's continuing to increase, and the job availability is decreasing. And so our labor situation is actually declining, and the Fed had an impact on that as well. So they're a bit late, which is why they are going to start to cut rates at their September meeting on the 18th. They'll probably cut by 25 basis points, with another 50 or so basis points cutting this year, to try to sort of normalize the negative impacts of the higher cost of money in the consumer market.
Yeah, probably agreed. You mentioned one interesting thing, and that is bankruptcy filings, and I saw that, and it was shocking to me that in August we reached like the highest level since 2020, and the second highest since 2010 or something like that.
That's right.
How important is to take this into consideration, and what other metrics do you see as highly concerning?
Right. So when we look at bankruptcies and the fact that they're as high as they were when the country was still coming out of the really significant impact of the financial crisis of 2008, all of those bankruptcies and the numbers up to 2010, which is where we're at now with the current bankruptcies, were part of a massive financial shock. And it takes a while for those sorts of shocks to work through the credit community, the credit spectrum, from personal up through corporate. And what we're seeing now with this rise in bankruptcies and the levels back to 2010, and that's just a mark. That could go back up to 2009 as well if we continue this path, which were higher levels than 2010, but that's just a mark in time. But what it means is that the strangle of higher cost of financing for consumers, whether it's paying their food or their rent or their utilities, all of which were increasing, on their credit cards, which were also increasing. So you start to see the hangover from that coming in, with then looking at personal bankruptcies, and then looking at small business bankruptcies, again, trying to make up and to borrow as much as possible to grow or to stabilize while costs are increasing at the same time. Those are hangover effects. So those bankruptcy numbers are very worrying because they're just a picture of what's really coming. It's really the impact of people trying and businesses trying to make ends meet until they can't. So that strain still exists right now because rates are still high, and even if they come down by a quarter of a point, 75 basis points this year, they're still high, and the impact is still in the ether, and I think that's really a concern. It's the same thing with different kinds of mortgage and real estate, distressed real estate, commercial real estate that's hanging on the books of banks in the United States and to an extent large banks globally because of, again, COVID hangover, different kind of hangover where office vacancies are rising. The leases that companies had that are coming due are being negotiated out of, right? So that people aren't renewing their leases, which means that the value of these large buildings with office vacancies declines. And that value is what is really behind the collateral for mortgages for commercial real estate. And then that declines. And then banks have to take losses, and then banks have to basically sell these assets back and forth to try and monetize some of them. And then that creates more of a leverage in the system. So I'm worried about all of these things. And to an extent, it's a big US problem. It's also a problem in France. It's also a problem in Germany. We've seen banks really struggle with leverage anyway. And now you have an overhang of sort of more expensive for a time money and the cost of capital, cost of credit coming due. And that can have knock-on effects, impacts as well in Europe, and less so outside, but certainly in the United States and Europe.
With mentioning real estate, do you see all over 2008? Do you see similarities? Do you see bigger crash than 2008?
I don't see a bigger crash because the actual acute leverage that we saw in 2008 on subprime mortgages and the way the banks manufactured what became known as toxic assets off of those subprime mortgages has been less extensive. And so for that reason, that acute problem, I think, won't have the same impact. But also the other thing that's happened is that the Federal Reserve, because of what they did in the wake of the financial crisis, which is basically create $4.5 trillion worth of money to buy assets, treasury bonds, and mortgage assets from the banking system at that emergency. And then they went up to $9 trillion. They threw in another $4.5 trillion in the wake of the COVID crisis, which is now down to $7 trillion. What that means is there's a lot of money that's cushioning the financial system. And in that respect, and the Fed doesn't talk about it that much, and we don't talk about it in a lot of interviews, whether they are on large or independent forms of outlets, because it's just not a thing, because the banks are not necessarily going to crash. But the reality is the Fed is still propping up the financial system. And as it's propping up the financial system in the United States, what that means is, because of all the codependencies with US banks and other banks, it's propping up the global banking system. And other central banks are involved in that as well, to smaller extents. But so the reason we won't have as acute a crisis, even if commercial real estate continues the delinquencies and defaults that it is showing, which are at actually the pace of what subprime we're at in the pre-2009 period. But the remedies that sort of came after that for the banking system are largely still in place. And I think that's why we could see a commercial real estate crisis, but it won't necessarily have the same overall impact that we saw because of all these subsidies from the Fed and the government before the 2008 into the 2008 crisis.
Yeah, so monetary policy is definitely wrong. I believe that even the creators of that know that. But is there a way, Nomi, that we transform the monetary system with this level of debt we have? Is it even possible to transform it?
It's an excellent question, because the reality is, if you look at the United States, we have $35 trillion worth of treasury debt. 5 trillion of which is on the books of the Federal Reserve. So basically, they're the largest buyer of treasury debt. And so for them to go away just for that reason will create a big problem for the United States Treasury, for the United States to fund its budget and so forth. And you look around the world, you look at the UK, you look at the ECB, you look at all the areas where there is still help. There's still like sort of a back buyer for debt, or a back guarantor of debt that allows for more debt to be created. You look at a country like Japan, of course, they sort of invented quantitative easing and have a massive debt to GDP ratio, and then they have had. So if you were to delete all of these central banks that have allowed for this debt to be created and sort of subsidized in smaller or larger manners, depending on what's considered an emergency or just sort of regular business as usual, getting rid of them would have a really damaging effect to national debt. Now, it would also make things more real. It might require countries to actually invest more in their growth, in their infrastructure, in their quicker energy transformations, in their people. But what central banks have become to be, particularly since the financial crisis, is really supporters of debt. They do other things. They say they do other things by moving rates up and down, but the reality is that's their biggest job. We just don't talk about it that much.
Yeah, spot on. What everybody is interested, from an average person on the street to a stock market participant, the question is pretty much the same. And how should one protect from the bad times that probably are coming in the near future? What should be done for capital preservation?
Right. So I always think that the idea of having real assets in one's investment portfolio, with one's buying with one's capital, is very important, because those are the things that hold their long-term value. And you might not see, for example, the increase in the gold prices over any 1-year period that you might have seen with Nvidia prices. So if you're looking for that sort of big payoff, those aren't necessarily the assets you'll buy. But if you're looking for steady, long-term use value assets, I think it's important to preserve capital and to be okay with patience for a slower but less volatile growth of capital in gold, in silver, in copper, in uranium, and in some of the companies that are involved in mining them, that have good global positions and solid geopolitical frameworks to allow them to mine and produce and to process and to transport. I think those are all very important. And I also think that having some cash on the side is important always. And I think the discipline of having cash on the side, it can be used for investing in these areas as well, but over time. So it's not on the side forever. It's there to be used for investment, but just in stages. And so I think that's really a prudent way of managing wealth. I think, some of the technology companies are very important to the future, and it's okay to have some exposure to them. But if I look at my portfolio, for example, right now, I'm probably about, I don't know, I'd say a third in real estate and more than a third in commodities and real assets and miners, and then sort of cash. So that's kind of where I'd say about 80% between the real estate and the commodities and the miners and the rest.
What other commodities are you following? You mentioned copper, uranium, gold, silver, of course. Is there any other commodities that you are following that you think that will perform good in the next period?
Yeah, so I think the magnet rare earth elements are a real area where you have to have patience, because there's a lot of volatility. There's a lot of geopolitics involved in that. China controls 60% of them right now and 90% of the processing, which means it can control pricing. But I think for the longer term, when we look at rare earth elements, we're looking at elements that are prevalent in semiconductor chips. They're prevalent in iPhones, in computers, in permanent magnet satellite logistical systems for defense departments, and they're going to continue to have more use values, particularly as they have magnetic properties that are much more efficient than some of the old magnetic properties, for example, in iron or other things that, you know, are sort of stalwart metals that also have conductivity. And so I think that's an area where you kind of put 5% in it and you just sort of deal with the volatility for a longer term payoff. And so I do have that as well in my portfolio. You know, I am on the board of a rare earth elements company, Meteoric Resources. And I think when we look at any of the companies in this arena, the possibilities for the elements that are provided, that are part of the 17 rare earth elements, are not even scratching the surface yet, I think, of where we can be from a sort of progress, technology, mining, efficiency, battery storage perspective. I think the science and the rare earth elements are going to continue to find each other over time. So that's an area I'm really excited about for a longer term.
Okay.
You know, so give it to your kids, generational wealth kind of things, as well as over the medium term, but you know, in terms of that major growth trajectory.
Yeah. I want to ask you a little bit about uranium. I saw your article. It was brilliant. And you stated the battle for uranium is set to skyrocket. What's your take on uranium and nuclear energy as a brand?
Yeah, so we did have that out on Prinsights .Substack, and we have both for specific trade ideas in our premium side, and we have the articles that you probably saw as well for a broader range of readers. And what I see is that the geopolitics of uranium, what's really escalated when Russia escalated its invasion of Ukraine, is that countries are doing a lot of things at the same time. They're rediscovering, repledging their commitment to nuclear energy. And they're rediscovering and recommitting their commitment to building plants and building capacity to utilize nuclear energy. They're rediscovering and financing small and micro modular reactors to be able to transport nuclear power to end areas, to not necessarily just rely on the large plants. And all of this requires uranium. And from the standpoint of national security combined with energy independence, the need for uranium and uranium supply has become, you know, as I mentioned in that piece, we'll continue to follow this for a long time, a battleground. The United States, for example, in May just passed a law that bans the import of uranium from Russia. Now there's some time, and companies can kind of apply to, you know, use some of it if they need to over time, et cetera. But it went into effect in late August. And what that means is the United States as a nation is committed to its domestic and allied uranium supply. And what that means, for example, is that uranium companies that operate in the United States that had closed their mines, either through just lack of funding or, you know, during the COVID period and so forth, are now reopening their mines, and they're starting to reprocess because they have a massive support from the United States government. That particular law provides $2.7 billion of financing for domestic uranium processing. But that's just one of several laws that actually passed in the last year or so, as the U.S. has, from a bipartisan basis, and Congress in the United States does not agree on lots of things, but they agree on the need for nuclear energy. They agree on the need for domestic supply chain or allied supply chain of uranium. And they agree that as an alternative energy source, it has a really good space between traditional fossil fuel energy in terms of a cleaner environment, and also more efficient, lasting kind of energy, and more alternative like solar, like wind, like green hydrogen, and so forth. So it occupies a very reliable middle of the spectrum area, which gives parties, which gives politics on both sides, conservatives or liberals, a place to actually agree. And that's going to continue. And that's not just in the United States. I mean, this is something, you know, Germany has readopted the nuclear energy, the UK, you know, we see it basically throughout Europe and throughout the world. China has the most increase in capacity projection of in the world, and that very fact is going to create more of a battleground for nuclear power and uranium and all the technology that's involved. So it's a big field that existed in a different form in the past, had scares within it, and now is really set for being potentially the most used form of energy on the planet.
Yeah, yeah. I want to hear your opinion on BRICS. I mean, BRICS and the expansion of BRICS is something we should pay more attention of. Do you believe that? Actually, how do you see BRICS in the future? That's my main question.
Yeah, so my PhD was basically on the triangle between my dissertation between Brazil, the United States, and China. Of course, Brazil and China being two of the major BRICS nations, and how, from a trade perspective, security perspective, energy resource perspective, they align and realign on different categories, and will continue to do that. And part of that is that the BRICS part of that, Brazil and China, are looking to have a sort of pole in the world, which is more independent of the United States policy and the United States dollar and so forth. And that is something that's going to continue to grow. And BRICS Plus, when we had additional oil producing, fossil fuel, old energy producing and still producing nations join BRICS Plus, that's not necessarily because the political views all align, but it's because from an economic and energy perspective, there is a true need there, and there's collaboration within the BRICS Plus community because of that. So that's what I think of when I think of BRICS Plus. I mean, it's a trade community, it's an energy community, it's a resource community. It's not necessarily we agree on every sort of political thing community. What we do agree on is having diversity relative to G7, relative to the United States, relative to the United States dollar. And that's going to continue to grow. The fact that the G20 meeting will be in Rio this year, coming up in November in Brazil, where Brazil has, this leadership role in defining, and the major topics at the G20 are going to be energy transformation, and also payment systems. There's a big component of international payments flow that the BRICS nations, particularly led by Brazil, want to expand, which is to have an international payment system that might not necessarily be based on dollar flows, but that will allow countries to transact with each other on whatever currency they choose, and however that develops, without having to go through SWIFT, without having to go through United States regulated or dollar denominated systems. And that's going to grow. What does that mean for the world? I mean, the world is changing. And where we've had a sort of dominant United States, we're going to continue. It's a huge military. The dollar is prevalent, and it's still the main reserve currency for central banks, and it's going to be for our lifetimes. But the reality is the world is changing, and it's changing because of resources, because of energy, the national security that's needed to protect and grow those things, and where populations are and where economies are most growing. And I think that's what really BRICS Plus signifies, and will continue to signify as we look at it, decades and decades from now.
Yeah, the world is changing, and it's changing fast. Nomi, last question. Actually, it's not my question. It is from one of my followers. Do you believe that banks will collapse, and could inflation lead to civil unrest?
Well, to take the second part of that question, inflation has led to less stability from an economic standpoint for people. And we were talking about, credit cards, bankruptcies, those kinds of things. But it's more than that. When people can't afford basic needs without struggling, that's when they start to blame each other for being in their way. That's when you start to see civil unrest. That's when you start to see that disillusion of trust in governments that probably already didn't have, the most solid of trust in them from people that were struggling to begin with. That's what inflation does. And whether that happens acutely in situations like post-COVID, or whether it happens because of a geopolitical event or weather event or whatever it might be, that does create more tension. That creates, inflationary prices create tensions. That creates civil unrest. There's absolutely no doubt that it's one reason among many for civil unrest. So that is a problem. With respect to banks, are banks going to collapse? We've seen some big banks, Credit Suisse, we've seen some big banks really have some major problems. Do I see another big bank in the United States collapsing? Again, they have so much protection from the United States. It's more likely we see larger regional banks, as we did last March, collapse because of over leverage or overextension or major delinquencies or capital flow. One thing that's interesting, I was just looking at on banks, is that The savings rate in the United States, for example, has declined because people are having to pay off their credit card debt, et cetera. Prices are higher, et cetera. And now the flip side of the Fed starting to reduce their rates is that banks are going to reduce their savings rates more quickly, because that's always what happens. They don't do it lockstep with the Fed. They kind of do it as fast as they can. They'd rather not give savers money for their money. And if that starts to happen as well, what banks could see as a result of that is more people taking their money and running it out of banks, and more deposit or decreases. And that could, again, hurt regional banks more specifically. The bigger banks probably have the wherewithal to deal with that, but we'll see more mergers and consolidation in the banking system as we do see certain crises in that sort of mid-tier section of banks come into play.
Yeah, let's see what happens. That was Dr. Nomi Prins. I want to thank you for coming to my show. It was an excellent conversation, a great chat. Really, thank you very much for coming, and I hope I will host you sometime soon again.
Thank you so much.